Good morning, students. Welcome to all of you at ICAI YouTube channel. Today is the last lecture on our buyback and buyback of equity shares. So specifically, I would like to ask you all whether you have done the questions which we have discussed in the previous lecture, because we have already covered illustrations. We have already covered some questions which you have to do. So tell me that how many of you have covered these questions. Also, your attendance will be there automatically. If you will send me that how many questions have been done by you, I would like to know that how many of you are present. So tell me how many are present. Have you done the question, my dear? बेटा फटाफट भेजो फटाफट फटाफट fast fast fast. Have you done the question? Today's topic will be a important and the interesting one, because we will have to cover the advanced topics of buyback today, which will obviously give you the benefit in your examination. Also, I have sent you some examination questions. Have you done those questions or not? These are the examination questions sent by me. This is the question which have been appeared in your November 2019 examination. Then there is another question. This is another question which has come into your examination. January, yeah. This has come into November 2019. Then this was again in January 2021. Then this is in July 2021. We are getting one question from this chapter every time. And the question is of normally 8 to 10 marks. So it meant for it will be a beneficial thing for us if we will do these questions. This will be the extra practice which you must have to do. Very good to everyone. Good morning to all. Charu, Harsh, Goel, Meman, Rafiq Bhai, Tulsiada, Barek, everyone, Pratiksha. But number of students have not sent here send good morning, because I know that how many of you are present. So send good morning so that I can understand that how many of you are able to attend the lecture with full attention, because attention is always required. So, beta, today's topic is specifically of something advanced which we have discussed in the previous lecture in theoretical part, and today we will do it in practical part. Actually, we have discussed that there must be a logical understanding of concepts of how many shares are to be buyback. That is to be kept into mind. That this is the most important thing that we should have to calculate, that how many shares are to be buyback. That you may see in illustration number 5. Let's see illustration number 5. Nikalo beta. Open illustration number 5. Pratham Limited, a non-listed company. The following capital structure is given to you. Equity capital, general reserve is given to you. Premium, profit and loss account, revelation reserve. You are required to compute by debt equity ratio test the maximum number of shares that can be bought back. In the light of above information, when the buyback price is rupees 30%. So this is a question in which he is interested from your side to make debt equity test. Now, what meant for debt equity test that we have already studied, I would like to review that once again for you. Debt equity test in buyback of shares. Buyback of shares and other securities. So, whenever we are talking about buyback of shares and securities, it means for there are equity shares also, because we are not discussing about preference shares, we are discussing about equity shares. In that, debt equity ratio was there, debt equity ratio that I have mentioned you, I have already discussed with you that after buyback, this ratio must be 2 is to 1 or less than this. Already discussed 1.9 is to 1 is okay, but 2.1 is to 1 is not okay. So you must have to understand this thing that this concept was based on the system that we must not have to convert a equity share into the debenture, into the long-term fund. We can't redeem our equity share from because we are interested to reduce our capital and interested to increase our debts, then obviously it will be a negative part of our business. So due to that reason, they are always keeping it at a limit. In that case, the benefit of those shareholders which will left will be automatically diluted, will be automatically destroyed, or will be automatically affected because in that case, more debenture holders will be there, more long-term funds will be there. They will have a more control on the business, and equity shares control will be reduced. So due to that reason, there must be a limit as per Companies Act. Very good. So let's understand this thing. To make it possible, he has asked you a query that after this, you should have to calculate debt equity ratio. Now, debt equity ratio must be 2 is to 1. It means for debts meant for what? Debts meant for long-term funds, long-term liabilities. You may say it. Now, these may be secured or unsecured liabilities. Secured and unsecured, both. Both will be taken. So, if both will be taken, there is no worry about it. In the given question, how much it is, check it out. I'm doing it very slowly so that you can understand the concept. In the given question, equity share capital reserve and surplus general reserve is given to you. Then long-term funds are automatically given to you. That is 42 lakhs. There's no need of calculating it in a proper way. It is already given to you. But in number of cases, it is required to be given. It is required to be prepared by you. It is 42 lakhs. Now, next is our equity. So definition of equity must be clear to everyone. Definition of equity meant for equity share capital plus preference share capital. In simple words, complete paid up share capital plus free reserves. Free reserves will be added in it. Also, in free reserve, we will add security premium and other reserves realized in cash, means which has been realized in cash. Any reserve which is not realized in cash will not be taken away. Any reserve which is not realized in cash will not be taken away. This was the definition given to you for free reserves. Free reserves means such reserves which are available for distribution as dividend. Any amount representing unrealized gains, notional gains, or revaluation of assets as a reserve or otherwise, or any change in carrying amount of assets or liabilities recognized in equity, including surplus and profit and loss account of measurement of the assets of the liabilities. Means in simple words, whatever reserve has been created from those amounts which are not realized in cash, from those incomes which are not realized in cash, will not be taken into consideration. Beta note kar lo ye baat. You must have to note it down. So due to that reason, I have given it to you. It is given into your module on page number 4.7. It's clear, beta. It's clear to everyone. So in this illustration, we have equity share capital worth rupees 30 lakh. This is paid up capital, fully paid up capital. No preference share capital is given to you. General reserve is given to you 32 lakh 50,000. This is always realized in cash if nothing is mentioned. So equity share capital is 30 lakh. To find out equity, take equity share capital of rupees 30 lakh plus GR general reserve 32.50 lakhs plus security premium 6 lakh. It is always realized in cash. Profit and loss account 4 lakh 30,000. So 6 lakh and 4 lakh 30,000 plus 4 lakh 30,000. So these all will be added. 72.80 lakhs. Is that clear to everyone, beta? 72.80 lakhs is the amount of equity with you. Now debt is clear to you, equity is clear to you. Our debt equity ratio should be what? Should be 2 is to 1 after buyback. That means for after buyback, debts will reduce or not? Debts will remain same. Hence, means debt will remain rupees 42 lakhs. It will not change na, because we are not going to do anything with the debts. So debts will remain same. It will remain 42 lakhs. Equity will change because we have to buy back these equity shares. How many equity shares are to be buy back, that is not clear to us. But these are to be buy back. And some amount is to be transferred from the general reserve, security premium, and profit or loss account to CRR. For the purpose of buyback, we have to transfer some amount from it. So it will reduce. This 72.8 lakh will have to change. Will change. So equity will change. Hence, we should have to make a limit of equity. Hence, minimum equity should be, it should be, if debt equity ratio should be in 2 is to 1, debt is to equity, it's 2 is to 1. If debts are rupees 42 lakhs, how much should be the equity? Tell me how much should be the equity. I'm waiting for your answer. How much should be the equity? Send me the answer. None has sent the answer. Fast, bit of fast. If that is 42 lakhs, that is, it's double the equity. It should be double than the equity. Equity should be 50% of the debt. Equity should be 50% of the debt. If you will say, if the equity is 21 lakhs, then the ratio will be okay. Then the ratio will be okay. It will be 2 is to 1. Sir, why revaluation reserve is not included for equity? Revaluation reserve is not realized, not a cash reserve. This reserve is not realized in cash. Any reserve which is not received to us in cash will not be become part of your equity for calculation of debt equity ratio in this question, in this chapter. Why revaluation reserve is not included in equity? Okay, is that clear? Already discussed. It is given on page number 4.7. Check your page number 4.7 of module. It is given there. It's 21 lakhs. Okay, beta. Current Sushil Kumar, the current equity is 72.8 lakh. We are discussing about the equity after buyback. Equity after buyback means that equity which we are assuming it as equity. We are taking equity only of those which are free reserves. And our definition of free reserves for this chapter is very clear. Free reserves meant for the reserves which are realized in cash. It includes security premium, it includes profit and loss account, it includes general reserve, it includes all reserves except those which are not realized in cash. Given on page number 4.7 of your module. Check 4.7 page number. So it means for equity should be 21 lakhs maximum or minimum. It should be maximum or minimum. Just assume equity is 20 lakhs. Then what will happen? 42 is to 20 lakhs. Then the ratio will be 2 point something. It will be 2.1 is to 1. Then it will become 2.1 is to 1. So that is not allowed. This is not allowed. Not allowed. So it should be a minimum equity. 21 lakh should be the minimum equity. If equity is more than 21 lakhs, means 42 is to 22 lakhs. Then what will be the ratio? The ratio will be 1.91 is to 1. This is okay. This is allowed. This is allowed beta. So let's understand the concept first that equity can be more than 21 lakhs, but it should not be less than 21 lakhs. So you should have to find out that how much should be the equity. This should be a minimum equity which is to be retained by you, 21 lakhs. If debts are rupees 42 lakhs. So what we have to do now? What we have to do? We have to go for the calculation now. We know that this equity will reduce after buyback. This general reserve will reduce after buyback because we have to create CRR, capital redemption reserve. So we will have to make a equation or an assumption, you may say, after buyback. What will be the equation? Let's make the equation. Let's assume amount transferred to CRR is equal to X that we have assumed. and amount, what you may say, another assumption, maximum permissible buyback of equity shares data. We have assumed it as Y, but because both are different. This is a maximum permissible buyback of equity shares, and this is amount to be transferred to CRR. Amount to be transferred to CRR will always be the face value. This will be the face value of buyback of equity shares, and this is the total amount of buyback. Because buyback is being made at the rate of it is 30%. So it will be at premium also. This includes premium also. This is the total amount. Let's make an equation. There are two equations which we have to frame. First equation is equation 1. This is what we know, that whatever the present equity, it will reduce by the amount of CRR. So present equity minus amount transferred to CRR minus amount transferred to CRR. Amount transferred to CRR. This will automatically reduce. One thing is this. Present equity is how much, that is clear to us because we have already calculated 72.80 lakhs. Amount transferred to CRR we doesn't know. We have assumed it as X. Now tell me one thing, whether we can make as much amount transferred to CRR as much is required, or we will have some limit also. Let's understand this. We have 72.80 lakhs with us. This is the amount available with us of equity. But the whole equity cannot be transferred to CRR. We must have to kept 21 lakh out of it as a reserve. Remaining is available to be utilized for the purpose of transfer to CRR. So we have to reduce 72 lakh, we have to reduce 21 lakh out of 72 lakh 84. Remaining is available for transfer to CRR. Total amount is not available for transfer to CRR. 21 lakh must be retained. This is the minimum reserve which you have to keep. Which you have to keep it in your record. So we may write it in other way also. Equation can be written in other way also. That is equity, whatever is the present equity you may write, minus minimum equity to be retained, that is 21 lakh, minus amount transferred to CRR. So this will be equivalent to what? This will be equivalent to the maximum permissible buyback of equity shares, because we are interested to get this. So this will be equal to maximum permissible buyback of shares. In simple words, we can say maximum buyback permissible is equal to Y, already mentioned, is equal to 72 lakh 80,000, out of which 21 lakh must be retained by us. This can't be utilized. Minus amount to be transferred to CRR, that is X. So Y is equal to 51,80,000 minus X. This is the maximum permissible buyback of equity shares. This is the amount of maximum permissible, because security premium is also to be written off it, out of it. We are not to write off security premium from somewhere else. That will also be written off out of it. So accordingly, we have done it. Y is equal to 51,80,000 minus. I am repeating it for you. How much is the present equity? 72,80,000. Beta, is that clear? Minimum equity to be retained by us. Now, minimum equity to be retained by us is equal to 21 lakh, which we have already calculated, minus how much amount is allowed to be transferred to CRR, that we have not calculated yet, that we have to calculate. It will be X. So Y is equal to 51,80,000 minus X. The equation will become. Have you noted it down, beta? Note it down. Having any doubt, tell me. Because this is step number 1. Then we have to go for step number 2 also. Note it down, beta. Or take the screenshot, whatever is required to you. I'm waiting for your doubts, if there is any doubt. Expecting there is no doubt. Equation number 2. So what will be the equation number 2? Equation number 2 will tell us the another calculation. We are interested to get the nominal value of shares to be bought by us. But we have assumed X is the amount to be transferred to CRR. Now we all know that amount to be transferred to CRR, amount to be transferred to CRR is always equal to face value of equity shares buyback. Equity shares buyback. Obviously, we have to reduce out of it whatever the fresh issue is there, that is not in the given question. If it is there, then it will be taken net of it. So it means for X is equal to face value of buyback of equity shares. Now, what is the face value of buyback of equity shares? Let's understand this. The total amount to be buyback, the total amount of buyback is equal to 51,80,000 minus X, or we may say Y. Y is the maximum permissible buyback of equity shares. So maximum permissible buyback meant for the total value of equity shares. Maximum permissible buyback or total amount of buyback. One and the same thing, beta. This is what over Y. It will be divided with the total amount. Now, buyback price is equal to how much is the buyback price? I'm writing here. Buyback price per share rupees 30 per share. So if it is rupees 30, if we will divide it with 30 and multiply it with face value per share, then we will be able to calculate the amount face value of buyback of equity shares, which is already equal to amount to be transferred to CRR, which is equal to X. So X is equal to 51 lakh 80,000. 51 lakh 80,000. That is the total amount of buyback divided by buyback share of buyback price of one share into face value one share. 51 lakh 81 minus x. So this equation will have to be solved by us. Here 3x plus x is equal to 51 lakh 80,000. So x is equal to 51.8 lakhs divided by 4. It is 12 lakh 95,000. Is that clear? I have tried to give you everything in detail so that you can understand this concept in a very clear manner. Just see once again so that you can understand the concept. Logical concepts are there. This is just same as mathematical equation is there, beta. Once again review each and everything so that you can understand this. If having any doubt, then tell me. I would like to make it clear once again if there is any doubt. Waiting for your answers. Is that clear or not clear? No one is sending the answer. Is that clear or not? There is a time lag, obviously. When you will send it, it will be received to me within a minute. It is not going to receive within seconds. It will take time. So until then, you will have to copy it so you can understand the concept. Amount to be transferred to CRR. This is the face value of equity shares. This is what? This is the face value of equity shares to be buyback. This is already discussed that how much amount is to be transferred to CRR. That is face value. So it means for we have assumed this thing, maximum permissible buyback of equity shares, or let's assume amount transfer to CRR. What it means for? This means for face value of equity shares to be buyback. Already mentioned you face value of equity shares to be buyback. So this is what? This is X. Total amount to be buyback to be paid to for buyback of equity shares, that is Y. So we have made first equation, that is this is the this is based on the limits. How much total amount of equity is available with us? 72 lakh 84. Out of which 21 lakh is to be retained. That we have retained, it is 51 lakh 85. Minus this is the face value of buyback to be made or the amount to be transferred to CRR. Whatever you may write, there is no problem at all. So amount to be transferred to CRR will obviously reduce by this amount. CRR can only be created from reserve. 51 lakh 80,000 is not available there. CRR can only be created from reserve. Okay, beta. Good question. Rakesh, we asked, but you should have to understand this thing. We have discussed again and again that CRR can be created out of general reserve, out of any free reserve. That is out of general reserve, out of profit or loss account also. Profit or loss account is also available with us. There is no problem at all. Second thing is we are not utilizing the complete amount here. We are writing here as security premium is also to be utilized for the purpose of free reserves. There is no problem at all. All reserves are assumed as free reserves except those which are not realized in cash. Again, I am repeating you. So everyone is saying understood, clear hai. That's very good, very good. Now we have calculated the issue price per share. Issue price per share is 30 per share for the total amount of buyback, and face value is rupees 10 per share. So accordingly, we have taken another assumption, another calculation, another equation we have framed that amount to be transferred to CRR is equal to face value of equity shares to be buyback. So X means face value of equity shares to be buyback is also equal to total amount of buyback divided by buyback per share into face value of each share. We get it. It is 12 lakh 95 pounds. Next, Y is equal to 51 lakh 80 pounds minus 12 lakh 95 pounds. That is minus X. So we are able to calculate this. It is 38 lakh 85 pounds. So this may be in crores. No, there is an error in module. You may write it. You may rectify it. It has been mentioned that this is in crores. So these are not in crores. In module, you have to rectify it. In the last line, where the answer is given, he has mentioned 12 lakh 95 crores. But I am unable to find that it is mentioned in crores anywhere, because in question it is given in rupees. If you will see the question, it is given in rupees, and rupees are not in crores here. So this must be rectified by you. Yeah, here rupees are not in crores, it is rupees. But in the last line, he has mentioned rupees in crores. So these are the problems which you have to rectify, because these are not in crores. I'm unable to find it. Beta, have you find out where it is mentioned in the question that it is in crores? It is 30 lakhs. We have taken it in lakhs. There is no problem. So everywhere it is mentioned that it is in crores. This is wrong. Here also it is mentioned that it is in crores. It is also wrong. So you may rectify it. Let's do illustration number 6 now. So finally the question is solved. Is that clear now? Let's do illustration number 6 now. This is to be done by you. I'm just trying to give you the concept so that you can understand this in a better way. Let's do illustration number 6. Read it fast. We have very limited time to solve this question. We have to solve it in a frequent manner. It includes 3 questions. It includes 3 cases. So we have to solve it one by one. He says this is the name of the company. Equity share capital is given to you 330. This is in crores. Reserve and surplus. So equity will have to include GR, security premium, and profit and loss account. Infrastructure development reserve may or may not be included. This all will depend upon its understanding. Just wait. Loan funds are given to you. Loan funds are 1800. This is what this is debt. This is the amount of debt. The shareholders, on the recommendation of their board, have approved a proposal to buy back the maximum permissible number of equity shares considering the large surplus available at the disposal of the company. The prevailing market price of the company's share is 25 per share, and in order to induce the equity shareholders to offer their buyback for their shares buyback, it was decided to offer a price of 20% over market. Means they will be given extra 20%. So this will be 25 plus 20%. So it will be how much? How much? It will be 25 plus 20%, 30. Also informed that infrastructure development reserve is created to satisfy income tax act requirements. So it means for it cannot be utilized for any purpose because this has been created for a specific purpose, and the purpose is to satisfy income tax act requirements. So we can't use it anywhere. So for calculation of equity, this will not be utilized. You are required to compute the maximum number of shares that can be bought back in the light of above information, and also under a situation where the loan fund of the company was either 1200 or 1500. Means this is another case. 1200 when the loan funds have been changed. Currently, how much is the loan fund? It is 1800. Loan funds are rupees 1800. So first of all, we have to treat it as 1800 and solve it. And then he says you will have to assume it as 1200 and solve it. Then change it to 1500 and then solve it. So three cases are there. Beta, you have to do it fast. Very good, Vandana. You have to do it fast, beta. First of all, calculate here. What we have done in the previous question, you have to do the same. Yes. First of all, you have to write down debts with you. How much is the amount of debts? You have to write down equity, minimum equity to be maintained, and total equity available with you. Three things you have to write out. So send me how much will be the total equity with us. First point you will have to solve. How much is the amount of total equity? Waiting for your answers. Fast. Answer must be sent within seconds. Don't waste your time. Case number 1 is going on when 1800 is the equity. When 1800 are the loan funds, means that is 1800. 1800 crores. How much will be the equity? Get fast. Send me how much will be the equity, beta. Do it fast. 330 plus 240 plus 90 plus 90. This will not be utilized. So this will be equal to 750. It will be 750 crores. So first point is clear. Very good. Now after buyback, debts will remain same. That is 1800 crores. Now how much will be the equity? Minimum equity to be maintained by you. Tell me how much minimum equity to be maintained by you. Fast. Total equity is equal to 750. Bandra, it's not 510. Why you have calculated 510? It should be 330 plus 240 plus 90 plus 90, because this is a part of equity already discussed. Equity share capital, general reserve is a part of equity, security premium is the part of equity, profit loss account is the part of equity. Only this is not the part of equity. 120 infrastructure development reserve. This has been created for specific purpose of income tax department. If you will use it, then our main provision will be affected, because income tax department is the legal department and we have to keep reserve for them whenever it is required, whenever it is compulsory. So you have to do it. 750 crores is the right answer. Rohan Jan, it should not be 900. 900, I don't know how you have. Yeah, okay. This should be 900. Next answer you have sent. Very good, Rohan. You come first. Rohan comes first. Anitha comes second. Vandana comes second, a third. So fast, beta, fast. First, second, third are declared. Remaining are all good. Everyone has done it. Very good, very good. Send the answers fast. So, what is the next requirement? So, minimum is already done. Next is we have to take assumption. Let's assume we have to check it out now. Just wait. 1800 is the no. One thing is very important in the given question. Just check it out that it should be 900 after a buyback. It should be 900 after buyback equity. It should not be less than buyback. It should not be less than 900. But it is already less than 900. It is already less than 900 before buyback. So whether we have to make buyback of equity shares or not, no buyback of equity shares is allowed. No buyback is allowed in the given case. Why? Because before buyback, we are unable to satisfy the condition. How will satisfy it later on? See, condition is 1800 is to 750. So how much it is? Current situation is it is 2.4 is to 1. If we'll make buyback, obviously it will further increase. Debt equity share ratio will further increase, which is not allowed because debt equity ratio must be 2:1 after buyback. तो बेटा बायबैक से पहले ही अगर वो 2.4 है तो बायबैक के बाद तो 2.4 से ज्यादा जाएगी, 3 चली जाएगी, 4 चली जाएगी, तो विच इज नॉट अलाउड. So there is no need of any calculation, there is no need of any testing. Just simple thing is there, no buyback is allowed in the given case. Is that clear to everyone, beta? After buyback, equity should be 900, but before buyback, it is 750. How it will increase after buyback? If you have to make buyback, obviously equity will have to decrease. So it means for buyback is not allowed in the given case. Tell me, is that clear? How come 900? Beta, it should be according to this. Beta, we have already done that if debts are 1800 crores, then how much should be the equity? It should be 2:1. Debts are 1800. If debts are 1800, then equity should be 1800 into 1 by 2. It should be 900. Because in that case, our ratio will remain this 1800 is to 900, that is 2:1. Then we have to keep a standard ratio. So our standard ratio is 2:1, in which equity should be 1 by 2 of debt. So that we have done. We have calculated as we have done in this question also. Debt equity ratio is 2:1. So we have done the same case 42 is to 21 lakhs. It should be equity should be more than this, not less than this. Already discussed with you. तो देखो मजा आ गया केस करके आपको ये. Have you enjoyed this case? I would like to give you another case to be done by you. When the funds are 1500, solve it. Tell me how much will be the equity. It will remain same obviously. How much should be the minimum equity to be maintained? Equity before buyback. After buyback, how much should be maintained? Giving you a minute, fast. Harsh Goel comes first. Very good. Before buyback, equity will remain same. It is 750. Very good. After buyback, how much should be the minimum equity? If loan funds are 1500, it should be 50% of it. So its 50% is again 750. So could we further make buybacks? If equity is to be maintained at 750 and that is only available now, whether we can go for buyback, that is not allowed. Not allowed. Because if we make buyback, our equity will reduce. And reduction of equity is not allowed more than the minimum equity to be maintained. Minimum equity to be maintained is 750. When 1 lakh 50, when 1500 minimum equity, 750, present 750, so on buyback. So no buyback. Very good answer, Rohinjan. Very good. Shabash, ma'am. Rafiq bhai, good. Vandana, very good. Anita, no buyback is allowed. Very good. Rohanjan, before buyback, Sam, very good. Vandana, very good. Very good. Shabash. Now third case. If it is 1200, could it be done? Fast. If it is 1200, could it be done? In the case of 1800, we should issue preference shares. Better, if nothing is mentioned, you can't do anything. You can't issue preference shares or you can't make your own assumptions. Okay, issue of shares is not our assumption. We can do only transfer to CRR, not more than that. It is not allowed to us that we have to make issue of preference shares or we can't. You may say because this is a big decision and this decision cannot be taken by us. This is a decision of the company. They have to take it. Is that clear, Rakesh? Rohan, when 1200 loan before buyback, minimum equity should be 600. Very good. Now, what you have to do? Let's assume. Let's assume face value of equity shares buyback is equal to amount to be transferred to CRR is equal to X. There's two assumptions: amount as a face value of equity shares buyback or amount to be transferred to CRR is equal to X. And maximum permissible amount of buyback, that is a total amount of buyback, including premium, is equal to Y. Now send me the first equation. How come the first equation? Fast. Fast. Very good. Anita comes first. Equation 1 is done. Very good. Waiting for others. Send me equation number 1. Eligible for buyback. Exactly right. Harsh Goel. Now solve it. Make equation number 1, then equation number 2. Fast, better, fast. Very good. Then 1200 loan before equity. Okay. Number of shares to be buyback 3.75. Number of shares 112.5. Buyback 3.75. Equity. Exactly right. Right. So I would like to write it here for you. Many have done it. Very good. Send me the equation number 2. Equation number 1 is finalized. It is y is equal to 150 minus x. Already done. Very good. Equation number 2. Send me the equation number 2. I am waiting for your answers. मुझे आता है, आपको करना है. Do it fast, बेटा. Rohan Jain comes first. Very good. Very good. Rohan Jain has solved it. Remaining is yet doing it, but increase your speed, beta. Equation number 2 is very good, Vandana. Very good, Harsh Goyal. Very good, Anita. Very good. Very good. Equation number 2, do it fast. Is x is equal to y divided by 30 into 10 because the price is 30. He says market price is 25. Market price is 25 per share. He says we are going to pay them extra 20%. We will pay them 30 rupees per share. So the buyback price is 30 rupees. So x is equal to 150 minus x divided by 30 into 10. Then we have replaced this y with this equation. And you have to solve it, get the answer fast bit. Fast, fast, fast. Very good answer. Vandana, you have done it. Great. Vandana, very good. Remaining, do it fast. Solve it and get the answer. Very good, very good. Rafiq bhai, very good. Increase your speed, fast beta. All must have to do it. No one will have to wait for the my solution because I'm not going to solve it for you. This is to be done by you. This is your question. Do it fast. Okay, tell me one thing. Have you done practice question number 1? Have you done practice question number 1? Yes, in the previous lecture or at your home? Practice question number 1. Have you done it or not? So answer is with you. X is 37.50 lakhs, 50 crores. And Y is equal to 112.50 crores. Done. Very good. Also write it in a proper way, then at the end that X meant for this, so this is this, Y meant for this, so this is this. Presentation is better given to your module. Use that presentation, that is always good. I'm never against the presentation given in your module, that is always good. So must consider that as an important guide for you. So tell me, have you done practice question number 1 or not? Practice question number 1. Have you done it or not? So let's go for the practice question number 1. Before that, I would like to review your concepts because some are yet on the concepts because they are not, that is not buyback can be made out of its free reserve, security premium, proceed of any fresh issue or of shares or other specified securities meant for debentures are not allowed to be utilized. Okay, my dear. Here you may write it down. Debentures are not allowed for buyback of equity shares. If those are issued, they are not to be considered at any level. Then No company shall purchase its own share unless the buyback is authorized by the Articles of Association or by a special resolution passed at a general meeting. In case of buyback is for a sum less than or equal to 10% of the paid up capital plus free, the same may be authorized by the resolution of the director passed at the duly convened. If it is less than 10%, then it can be done at the resolution passed by the director. Otherwise, we have to go for special resolution if it is more than that. The buyback is for less than or equal to 20%, 25% of the paid up capital in 3 years. So this has already been discussed. Now we have to do this in a practical way. The buyback is 4. Is 4 nahi hai yahan par. Here it should be 4. Is for less than or equal to 25% of the paid up capital and free reserves of the company. So that is our test which we have to make before making a buyback, just like debt equity ratio test. Partly paid up shares cannot be buyback means if it is given in the question that we are interested to buy back the shares and few shares are partly paid up and few are fully paid up, then we have to make buyback of only fully paid up shares, not partly paid up. It should not exceed 25%, but we have already discussed that if it is to be done within a year, there must be a gap of 1 year between two buybacks, then obviously this condition have not too much value for us in practical point. The ratio of debt equity should be should not be more than twice the paid up capital and its free reserve after buyback. Debt equity test already done by you. As per the Companies Act, companies can issue equity shares with a differential right. This is the most important practical point which may come into your exam, not important from practical point of view. What meant for the differential right when equity shares are issued with the extra voting power. Extra voting power. They are given double voting power or the triple voting power, then in that case they are assumed as a equity shareholder with differential rights. Normally equity shares are to be issued of the same category, of the same system. But if they are issued with the special advantage to them, then they are named as differential. The right of a particular class of shareholder can be varied, provided more than 75% of the class agrees. Means it can be done only if other shareholders also agree. If this variation affects any other class of shares, then the consent to more than 75% of the other class of shareholder is also required. Means if we have two types of equity shares, if we have equity shares of single type and we are interested to issue equity shares with differential rights, then we have to get permission of the previous equity shareholders also. And those equity shareholders must be the consent of minimum 75% of the existing shareholders must be taken. And also another point is there, if 10% of the shareholders doesn't give you the approval and they collaborate with each other, they can file a plea against you. Means assume there are 1 lakh equity shareholders. We are interested to 1 lakh equity shareholders. We are interested to issue some equity shares of different category with a differential right which will affect the right of these 1 lakh shareholders. Then we have to go to these shareholders and get the permission. We have to get permission of minimum 75,000 of the equity shareholders. If they agree, we can do it. But even then there is one more condition. And that condition is, this condition is satisfied by me that 75% are agreed. But one more problem is there. If 10,000 shareholders go to the tribunal and make a plea that they are not agreed to for this purpose, then they can sue us. They can give a plea, and this can be temporarily stopped, and then we have to fight for it. And finally, if we will win, then only then we can issue that. Otherwise, we are unable to issue. This is all practical part, beta, not a practical point of view. It is not important from private. It is practical point of view. In illustration number 4, why premium and buyback are not written off? Because Sonu Kumar Singh, we are just making calculations. Everything is to be written off. Everything is to be written off. Whenever amount is transferred from security premium, we have to do it, obviously. Next. Now we have to go for the testing. Yes. Practice question number 1. SMM Limited has the following capital structure as on 31st of March. Equity share capital is 1200, situation 1. General reserve, security premium, profit and loss account is given to you. Infrastructure development reserve is given to you. Loan funds are given to you. Company has offered buyback of 30 per share. You are required to calculate maximum permissible number of equity shares that can be bought back in most situations and also required to pass transactions. So this is the question which you have to solve. Equation number 1 you have to solve first. For that purpose, our first condition is to be satisfied first. How much buyback can be made by us? How much buyback can be made by us? Maximum permissible buyback. Read the question once again. You will be able to understand the concept. So first is 1200 shares are with us. We have to go for the what he demanded from me. He have demanded to do the question in a proper way. Full question is to be done. So if 1200 is the equity shares available with us, then our condition is very well. Simple equation is there that 25% of the equity shares can be 25% of the equity shares can be buyback. So 25% of 1200 is equal to 300. So this is the first condition. But second condition is also there. That is 25% of the 1200 equity plus general reserve plus security premium plus profit and loss account plus infrastructure development fund will not be taken. So it will be 25% of 2880. It is 720 crores. So either we can go for 300 or we can go for 750, or we have to fulfill our third condition, that is debt equity ratio. It should be 2:1. So before buyback, our equity is 2880. Debts are how much? How much is the amount of debt? 3200. Debts are 3200. So if debts are 3200, then equity should be 1600 after buyback. It is 2880 now. After buyback, it should be 1600. So it means for we have to make calculations properly. So now it's your duty to do it. First, we have to solve it once again. Same equation number 1, make equation number 2, and then solve it. Send me equation number 1, equation number 2, fast. How much will be the equation number 1? Fast beta, fast. Speed से करना है काम. Very good question of comes into your examination. So we have to solve that also after this. Send me equation number 1 first. Y is equal to, yes, 2880 minus 1600, very good, minus x. So y is equal to 1220, 1220, 1280, 1280 minus x. Very good. Equation number 2, x is equal to, fast beta, fast. Now you have to increase your speed. Harsh Goel comes first this time. Very good. Very good. Y is equal to 960. Very good. Very good. You have done it. Rohanjan, very good. Shabash. Harsh Goel, very good beta. Shabash. So assuming everyone has done it, very simple, na? Very easy and simple. Nothing typical in this. So if condition is changed, he says it will be instead of 3200 crores, it will be 6000 crores. Then what will happen? Very good, very good. Rafiq bhai, very good. So if it is 6000, then what will happen? Before that, I would like to discuss one more thing with you. See the solution of this as given in your module. Yeah, we have made these tests. Okay, beta. Share outstanding test in which we can maximum make buyback of 30 crores of the shares. According to resource test, we can go for maximum 24 crores. According to debt equity ratio, we can make maximum 32 crores. So how much can be done maximum? Least out of these three will be the maximum. Least out of these three will be the maximum amount. Because we have to make all these three tests. These three tests will tell us that how much amount to be. We are going step by step. The concept is to do the questions step by step mode. To understand the question in step by step mode. This type of question will come into your exam. Then you have to do in this way. First of all, calculate the 25% of your equity share. Then equity plus debt का 25% निकाल लेना है. Then you have to go for debt equity ratio 2:1 test, and whatever comes minimum, that will be your answer. So 24 is the minimum out of these three, that will be your answer. So this will be the amount of buyback which you have to make. Is that clear to everyone? Now journal entries. Equity share buyback to bank account 720 because it will be into 30. Equity share premium, 2 equity share buyback. Security premium, general reserve, 2 premium payable on buyback. GR to CRR, that's it. Then we have to prepare balance sheet also. Have we demanded the balance sheet also? No, we have not demanded it. If he's saying to prepare balance sheet, then that must be prepared after making all adjustments. So in second case, it is 30, same. It is 24, same. But here, it is not allowed. Everyone is understood? Because 6,000 crore is the amount of debt. And we can go for maximum 3,000 crores of equity. But equity is how much? Because when we go for debt equity ratio test, see here it is, we have done it. Yeah, here we have done it. It is 6,000 crores. It should be 3,000, and accordingly, present equity shareholders are fund only 2,880. So it is already less than this. So we are not going to make any fresh issue this time. We are not going to make any buyback this time. Is that clear, beta? Question number three is also very important. Question number three is also very important. Yeah, let's do it. Following is the balance sheet of Competent Limited that is given to you. Details are also given to you. Here you may see all the reserves are allowed because see that all the reserves are revenue reserves, free reserves. So these are allowed. This is the total amount of debt, 28 lakh. This is some advanced question, some good question, but you can do it very easily because now you know each and everything about this chapter. Company wants to buy back 25 on equity shares at the rate of 20 per share. Buyback is duly authorized by its articles. This payment for buyback will be made by the company out of sufficient bank balance. Whether buyback of some shares by the companies within the provisions of the Companies Act, he is asking you whether it is allowed or not. So beta, start with this. You will have to tell him whether it is allowed or not. For that purpose, first of all, make the resource test. We have to make three tests as we have already discussed in the questions. First is our share outstanding test. Share outstanding test. Now, what will be the share outstanding test? Tell me how much it will be. I am waiting for your answer. Share outstanding test you have to do. How many shares are with you? 12 lakh 50,000 is the value of shares with you. Or in simple words, we have 1 lakh 25 on shares with us. How much maximum shares we can buy back? 25% of it. 25% of 1 lakh 25. Shares to be buyback is 31,250 at the rate of 10 each. Face value of maximum shares to be buyback is 3,12,500. This is test 1. Now test 2. In test 2 he says 25% of equity. So how much is the equity in the given case? Equity is 12 lakh 50,000 plus 18 lakh 75. 12 lakh 50 plus 18 lakh 75. You may get it. It is 7,81,250. Now, in this case, the important point is this is the total amount. Here we are getting the number of shares. Number of shares. Because this is share outstanding test means how much shares will remain outstanding after the buyback. That will be 75% of the current shares. So current shares are with us. We will maximum go for the buyback of 25% of the shares. So this will be based on the number of shares data. Now understand the concepts because I have done it step by step so that you can understand in a better way. Otherwise, it will be very typical. So accordingly, questions are also with you. But when solving the question in your exam, you have to solve the question just same as given in question number third, because this is a complete conceptual question which you have to do in your examination. In module also it is given in a different way so that it should be easy to understand. But finally, when we will get a question in your exam, first of all you have to make sheer outstanding test. Second, you have to go for resource test. Resource meant for how much resources are available with us. So that is 25% of equity. This is total amount of shares to be buyback, and it includes the price, issue price, buyback price, total price. This is the total price. That is face value plus premium. That means for in the given case, buyback price is 20 per share. See how much it is. It's 20 per share. Yeah. So it is 20 per share. So he says 7 lakh 81,250 is allowed. But number of shares is to be calculated by dividing it by 2. Number of shares. This is the total amount to be utilized. The question has been asked by a student named Sonu Kumar Singh. Sonu Kumar Singh, you have asked why premium on buyback is not deducted out of it. That is to be deducted by way of this, because we will divide it by 20, not by the 10. Because we are calculating the amount earlier. Now we are calculating the number of shares. So exact part is this. Because out of this total amount to be utilized will be will be including premium. So maximum number of shares to be buyback is 39062. 39062. Here we are saying that we can buy back maximum 31250, because in this case he have asked about the number of shares. Earlier the amount was the point, so we have done it accordingly. Question was framed according to that. But now the complete concept is to be seen. Copy it so that I can proceed further. Copy it fast. Now third test is debt equity test. So debt equity ratio test we have to do. For this, debt is given to you. Debt is equal to how much? That is 28 lakh 75,000. So minimum equity should be to be retained should be equal to 28.75 lakhs divided by 2. I am saying so that I can maintain 2:1 ratio. So it should be loan fund is equal to, just see how much is the debt. Just wait. Debts are 28 lakh 75,000 plus yes, very good concept. Here we are seeing that current liabilities are also there. Current liabilities are also part of debt, because I have already mentioned you debt means for all outsider liabilities. So here it is 28.75 lakh plus 16 lakh 54. 16 lakh 50,000. So this is the total amount of debt. So minimum equity to be maintained is equal to, this is 45.25. It is in thousand, not in lakhs. 28 lakh. Okay, it's okay. Lakhs. Minimum equity to be maintained 22.125. 625. Okay. This is the minimum equity to be maintained. 22.625. Now you have to make your equation. Solve it through an equation, whatever equation we have discussed earlier. Very good. Everyone has solved it according to my opinion, because Rohan Jain has sent the answer, Nisha has sent the answer. Number of students are doing it very, very good. So equation you have to make, y is equal to total equity. That is, how much is the amount of total equity? 12.5 plus this 18.75. So it is 31 lakh 25 minus minimum equity to be maintained 22.625 minus x. So this was the first equation which we have to prepare. 8.625 minus x. And another equation is x is equal to y divided by, here the price is 20 into 10 is equal to 862500 divided by 20 into 10. Easily get it out. 86 lakh 2500 divided by 20. Minus x. So it is 2x is equal to, x is equal to so you can solve it now. So you have to solve it completely. Is that clear to everyone? A good question from examination point of view. If you will see this, so 31 from 250 is the first test. According to second test, it is 39062, and according to third test, it should be maximum permissible amount of buyback is given to you. This is already done by you. Working note number one, you have done for this same 28 lakh 37,500. Maximum permitted buyback of equity shares is 5 lakh 75. 5 lakh 75,000. So maximum number of shares that can be bought by divided by 20 you have to do. You have to do it by divide by 20 because it's a total amount. Total amount hai, so you have to divide it by 20. Because here also you have to divide by 20. In the previous case also you have to divide by 20. Resource test in share outstanding test you are calculating on the basis of your main share. So actual buyback is 25 pounds. So it is allowed because it is also allowed according to this assumption. In resource test also we check it out that 25 pound is allowed because here we have been allowed to buy back 39062 shares. So it means we can easily buy back these shares. Having any doubt in these questions, tell me. Very good, very good. Review this once again. After the break, we will meet once again and do examination questions. Sir, may we have a break? Ramji, Ramji, break. Welcome back after the break. So start with the examination questions, beta. Ask me practice 4. Okay, practical 4. Neman bhai. So that's better. Do the last question also, then we will start with the examination questions. Do the last question also, question number 4. This is a question with some good point. It's a small question, but it is good. From conceptual point of view, it is important. So see, practice question number 4 also. Question number 4. W, X, Y, and Z hold equity shares and is held by them in proportion of 40, 30, 10, and 20. So this is a proportion, means this is basically the existing shareholders W, X, Y, and Z. A, B, C, and D hold preference shares in the proportion of 30 is to 40 is to 20 is to 10. So these are the preference shareholders. They have their own proportion. Equity shares have the own proportion. And the paid up capital of the company is 40 lakhs. This is the total paid up capital of the company. Equity capital 40 lakh and the preferential capital is 20 lakh. The paid up capital of the company is 40 lakh, that is paid up equity capital. And preferential capital is 20 lakh. We have to find out their voting rights in case of resolution of winding up of the company. Basically, when the winding up is there, then preference share also get the right of voting with them. So how to calculate their voting system, that is discussed in this question. We may directly do it by seeing the solution. There is no problem because it is comparatively easy and logical question. See, here it is given to you. He says their proportion is 40, 30, 10, and 20, whereas the share of A, B, C, and D is 30 is to. So paid up capital, equity capital is 40 lakh and preference capital is 20 lakh. So the ratio of the capital is 2 is to 1. If you will see, the ratio of the equity and preference capital is clear. It is 40 is to 20. So ratio of the capital is 4 is to 2, 4 is to 2, or 2 is to 1. So this will be taken as a base. Nothing else is there. The total cap. This is 40, 30, 10, and 20. So W की बात करते हैं. We will talk about W. So W share is out of this 2 by 3 into 40%. So it's 4 by 15 that he has calculated. Then 2 by 3. All equity shareholders will get the benefit of 2 by 3 and preference shareholders will get the benefit of 1 by 3. 1 by 3 into their ratio. 30 is to 40 is to 20 is to 10. 30%. 1 by 3. So this is the way how they are calculating their 1 by 3 into 20%. All that is there. Maybe it is clear, but please ask me. Okay. Ravik bhai, is that clear? So this is basically simple, that relative weightage in the voting right of equity and preference will be 2 by 3, 2 is to 1. So that will be taken as a base for calculation of voting rights. So 2 by 3 will be the base for equity shareholders, 2 by 3. And for them, it will be taken as 1 by 3. Means whatever is the total vote, it meant for total votes will be 15, out of which 4 votes will be W. Out of 15 votes, 3 votes will go for Y. Total votes will be 50. Even there are 8 persons, but they have the right to vote 15 votes. And out of 15 votes, he has been given a weightage of 4 votes. And he has been given a weightage of 3 votes. He has been given a weightage of 1 vote. He has been given a weightage of 2 votes. He has been given a weightage of 1 vote. Weightage of 2 votes. We have to make the denominator same. Here there is a problem because here it is 1 by 10. We have to make it equivalent to 15, or we have to make weightage of all the votes equivalent. So you can multiply all with the Now we will make them even equivalent by doing this thing, like W X. What they are doing in practical. Here it is not required at all. W Z A B C and D. So answers are with you 4 by 15, 3 by 15, 1 by 15, 2 by 15. Assuming it's clear now, 1 by 10, 2 by 15, 1 by 15, 1 by 30. Now, biggest one is 30 and it is better to make all 30. So it will be 8 by 30, 6 by 30, 2 by 30, 4 by 30. Here it should be multiplied by 3. 3 by 30, 4 by 30, 2 by 30, and 1 by 30. So it means for total weightage will be 30 votes. 8 votes will be weightage of W will be equivalent to 8 votes. Weightage of X votes will be 6. So this will be the concept how it will be prepared, how it will be used. Something technical but logical. Assuming it is clear, so let's do examination question number 1. Read it and do it yourself. In front of me, I would like to see how you will solve it. Have you got the examination questions which I have sent it to you? Buyback of share. This question has appeared into your exam in November 2019. Good question from examination point of view. Equity share capital of rupees 20 each, fully paid up. 50 lakh shares. 50 lakh is the value. 10,000 preference shares. 10 lakh is the value. Then capital reserve is given to you. Security premium, revenue reserve, profit and loss account, and dividend equalization fund. Debentures are given to you. Shareholder adopted the resolution. Buy back 25% of paid up capital. And it was decided to offer a price of 20% over market price. So they will be buyback at which price? 30 plus 20%. For that purpose, they will finance the buyback of share company. 3,000 debentures are issued and 25 preference shares are issued. Minimum 2 lakh is to be maintained in revenue reserve, means revenue reserve cannot be utilized more than 2 lakh. Company issued 3 fully paid up equity shares. You are required to pass the entries to record the above transaction. So your duty is to first of all tell me how much will be the amount of CRR to be created. Do it fast. How much will be the amount of CRR to be created by? Send me from which how much amount will be utilized fast. Do it fast. वेरी गुड, स्पीड इट अप, जल्दी करो. Here are 19 lakh 50,000 sent by Rohan Jain. Do we include provision in debts? Why? Why you will include Rohan Jain 7 lakh CRR? So according to me, I will have to mention you how much will be the amount of CRR because you are not able to calculate same. Harsh Goel is saying 10 lakh. Okay, no problem. Do it fast. Do it fast, beta. So simple. Number of shares to be buyback. Buyback will be 50 lakhs into face value is 25%. So it is 12.50 lakhs to be buyback at a price of 36 per share. So to create a CRR of 12.50 lakh, you should have to check how much will be the face value of buyback minus fresh issue, if any, that is to be deducted. How much is the value of fresh issue that is given to you? He's saying we are issuing debentures and preference shares. So we have to take preference shares only because debentures are not allowed to be issued for the purpose of buyback of shares. So 2500 into 100, that is 2.50 lakhs. So CRR is to be created for 10 lakhs. Very simple. CRR is to be created for 10 lakhs. CRR is not 7 lakh beta. Those who are saying 7 lakh must let it be clear that debentures are not allowed to be assumed issued for the purpose of buyback of shares. This is a separate issue. This is assumed that issued for the purpose of arranging money, but this is not for the purpose of affecting us or helping us in buyback. So here only equity shares and preference shares can be issued, not the debentures. So be sure that it is to be done in this way. Kushi, you are also wrong. 12.5 lakh is wrong. 15 lakh is also wrong. Only 10 lakh is correct. So CR is to be created for 10 lakh. Is that clear to everyone? Now, how to utilize reserves, that you have to see. 10 lakh we can utilize from these two accounts. We can utilize revenue reserve first. Revenue reserve, he says we have to keep minimum 2 lakh revenue reserve with us. The complete revenue reserve is not to be utilized. He says we have to maintain a balance of 2 lakh in revenue reserve. So it means for revenue reserve can be utilized maximum by the amount of rupees 3 lakh. Out of this 3 lakh will be utilized. Is the amount of premium. It is 32 lakh 50. So this is the amount required for premium. So for premium, we will have to use security premium, 12 lakh. Going to 16, because out of 36, 20 will be the face value and 16 will be the premium. First of all, get the number of shares, number of shares to be buyback is equal to 12 lakh 50,000 divided by 20. 62,500 will be the number of shares to be buyback. So premium on redemption is equal to 62,500 into 16. It will be 10 lakh. To be written off from where? From security premium, because that is available for rupees 12 lakh, so there is no problem. From security premium. So can you please show once you how to solve amount transfer to CRR and maximum buyback, I mean X and Y. But in this question, it is not required to be checked because that is all mentioned in the question. Just see the question. He has already decided how much should be the buyback. He is not interested you to check it out. So there's no worry about it. There's no need of calculating X and Y in the given question. The shareholders adopted the resolution on the date of the above mentioned balance sheet. Buyback 25% was a paid up capital and was decided to offer a price. Prevailing price is this. So all things are already decided. We are not the part of decision here. When he says you have to calculate how much should be the amount of buyback, then you have to do it. But this question doesn't mention this thing. In this question, he have already done that 25% of the paid up capital is to be buyback. Obviously, it satisfies condition number 1 as well as condition number 2 is also satisfied. Condition number 3 is the only part which is required to be checked. If we are interested to check, you may check it out. If you are interested, there's no worry. If you are interested to check it out, you can do it by doing this. It is 12 lakh 50,000. Total amount of debt is equal to 12 lakh 50,000 plus 5 lakh 50,000. It is, if you are interested to check it out, you may, but it is not required in this question. Up to your choice is there. It is 12, 18 lakhs. So it should be 9 lakh. That after this, it should be 9 lakh. This is the minimum cap equity to be maintained. Whereas equity is already too high, there's no problem at all, because there is no chance that equity is going to reduce, because we have equity capital of 50 lakhs. Only equity capital. Reserves I am not considering. You may see equity capital is 50 lakhs. If you will reduce it by 12.5 lakhs, it will left with 37.5 lakhs. So at no chance it is going to reduce less than 37.50 lakhs. So having sufficient amount of capital with us, equity capital. Also we have preference capital in the given question. So in this question, debt equity ratio test is not required, beta. Also it is not required when it is not specifically given in the question that you have to tell us how much permissible, how much is the permissible amount of buyback we have to do. If he is not asking you, you will have to do it as a simple question, just like redemption of preference shares as we are doing. So we will do in that way. Okay, bhai? Beta clear hai? So 10 lakh will be written off from security premium. One more important thing is there in the question. He says we have to issue equity shares also. Company issued 3 fully paid up equity shares of rupees 20 each by way of bonus share for every 15 equity share held by the equity shareholder. Now, how many equity shares are with us? Equity shares after buyback. It's 37 lakh 50,000 divided by 20. It is 1 lakh 87,500 shares. Equity shares after buyback is 1 lakh 87,500 shares. So, number of bonus shares to be issued. Bonus shares to be issued. 1 lakh 87,500 into, he says we are issuing 3 fully paid up equity shares for every 15 equity shares. It is 3 by 15. That is 7,500 equity shares will be issued as a bonus share at the rate of rupees 20 beta. The total value is 7 lakh 50,000. This entry will be passed on the basis of CRR account debit. To bonus to equity shareholders. ₹7,50,000. Next, bonus to equity shareholders to equity share capital. Bonus to equity shareholders. Debit to equity share capital. 7,50,000. These two entries will be passed. Is that clear to everyone? Is that clear to everyone? Please tell me. This question is simple and easy question. If you will see, you can easily do it in your examination. Everything is clear in this question. Charu is asking, sir, can you please show once how to solve amount transfer to CRR and maximum buyback in question number 3. In question number 3, okay, beta, just do it. In question number 3, this was question number 51 lakh 80,000. Yeah, this is the question number 3. Huh? Yeah. First equation was very simple. We have to make share the outstanding test. In share outstanding test, we have done it 25% of total share, that is 1,25,000. We have done it. It is C1250. Then resource test was there, 25% of paid up capital plus free reserves, that we have done. This will be the total amount. So it will be divided by 20 to calculate the number of shares, because we have to divide it by face value of share, issue price of shares to calculate the number of shares to be buyback. So it is 39060. Then beta, it is total debt 45.25. What we have done, we have calculated minimum equity to be retained, that is 45.25 into 1 by 2, that we are doing to calculate the minimum equity to be maintained. So it is 22.625. An equation is there, y is equal to 31.25. I have taken from the previous page, that is free reserves. This is 12.50 plus 18.75. This is the equity share capital plus share capital plus free reserves. 31.25 minus minimum to be retained minus face amount to be transferred to CRR. So the equation is there, y is equal to 8.625 minus x. And another equation we have framed, that is x is equal to total amount permissible, maximum amount permissible divided by issue price per share into face value per share. Whatever is the face value, that is multiplied. And we have to solve these two equations to get the answer. Is that clear, beta? Any doubt to Charu? Charu, is that clear? See one more question given to your exams. This is January 21. Director of Umang Limited passed a resolution to buy back 5 lakh shares at the rate of 15 per share. Buyback is compliance with the provisions of the Company Act. So this buyback is already done, already checked out that this is in compliance with this. So we doesn't have any problem, beta. Accordingly, here mentioned investments are sold, equity shares are issued, 15 lakh premium is to be used, company has necessary cash balance to make the payment. You are required to pass journal entries. We can easily do it because it is simple and easy. We can do it. Next is company provides the another question. This has come into your July 21 examination. July 21 examination. So here two situations are given. Equity share capital 30 lakh. Reserves are given to you. Loan fund is different. It is 25 lakh and 1 crore 20 lakh. The company is planning to offer buyback of equity shares at rupees 30 per share. You are required to compute maximum permissible number of equity shares that can be bought back in both the situations as per the Companies Act, and also required to pass necessary journal entries in the given case. So it's your duty. Do it now. Do it now. Fast, fast, fast. Tell me whether it is allowed. Question is with you. Make first test of in situation 1. First test is share outstanding test. Share outstanding test. Do it fast. How much it will be in situation 1? Obviously, same will be in situation 2. According to share outstanding test, how much should be the how much should be the number of shares to be buyback? Get it fast. Send me the answer. I would like to see that you are doing it. Fast better. Very good. 75,000 or 7,50,000. It is 75,000. Very good. Next is resource test. For the resource test, first of all, tell me how much is the value of equity. Tell me the total value of equity with you. Fast. Send me the equity. Yes. Tell me the amount of equity. Very good. Rohan Jain comes first. Equity is 50 lakh 10,000. Very good, Rohan. Shabash. And resource test says we have to make it multiplied with 25% to get the maximum value of maximum amount permissible to be transferred. No, maximum amount of buyback of shares. It is 12 lakh 52,500. Now, number of shares, if you are interested to get, then you have to divide it by 30. Only then you can get the number of shares. It will be 41,750. This is to be divided by the issue price. This is to be divided by the buyback price, not by the face value. Rohanjan, rectify it with you. 20 lakh 10,000 is wrong. Charu, Rafiq Bhai, Kushi, you are correct. Harsh Goel, you are correct. Very good, very good. Number of students have done it. Very good. You have to add all these, not the statutory reserve, in equity capital. Then you will get the total equity. Total equity is equity share capital plus free reserves. This will be 50 lakh 10,000 into 25%. This will be 12 lakh 52,500. To get the number of shares to be buyback, it is to be divided by 30. Beta, is that clear? Third is the debt equity ratio. Debt equity test. So for that purpose, first of all, you have to calculate how much should be the minimum equity after buyback. After buyback, your minimum equity should be 12 lakh 50,000. And in this case, minimum equity should be 60 lakhs. In the given case, total equity is 50 lakh 10,000 before buyback. So whether it is allowed to be in situation 1, is that allowed to make buyback or not? In situation 1, is that allowed to make buyback or not? And in situation 2, is that allowed to make buyback or not? चारू सर वो मे रिजर्व का बिल्कुल सही बता रहे हो चारू, यू आर करेक्ट, वेरी गुड, शाबाश. Now tell me whether it is allowed to make issue according to debt equity ratio concept in situation 1 and in situation 2. In which it is allowed, 1 or 2? Rohan Jain again comes first. Very good. But we will see that whether you are correct or wrong. I don't know. I have not checked it out. In situation 1, it is allowed to make or not. In situation 2, it is allowed to make or not. Tell me. Here, your equity plus free reserve is equal to 50 lakh 10 pound, whereas according to debt equity ratio, it should be 60 lakh after buyback. So it is already less than that before buyback. So there is no need of making any buyback in this case. Yeah, buyback will be done in this case. We have to do it. So do buyback in first case. What will be your equation number 1? Waiting for your equation number 1 and then equation number 2 and then answers. Equation number, very good, very good. Equation number 1, y is equal to 50 lakh 10,000 total equity lakh 10,000 minus minimum to be retained 12 lakh 50,000 minus x. So it is equal to 37 lakh 60,000 minus x. Very good. And x is equal to face value of buyback 37 lakh 60,000 minus x divided by 30 into 10. So x is equal to 9 lakh 40,000. So this is the face value of buyback. So number of shares to be buyback is equal to 94,000 shares, because it is face value is rupees 10. Very good, very good. Everyone has. I may assume that you are perfect in buyback of shares now. Are you feeling that you can do it in your exam very truly? You can do it your exam with a very speedy manner correctly. There's no problem at all. So you tell me. Very good, very good. Everyone has done it within the time schedule. You have done it within just 5 minutes. So this is named as speed. This is named as practice. This is named as that you can do it. I would like to take some doubts also. If there is any doubt in some other way, wherever it is possible, because lectures are already completed. Already all the chapters, whatever is given to me, I have tried to give you the benefit. You can understand the chapters very well. We have done advanced partnership accounts. We have done ESOPs. We have done buyback of shares. Whether every chapter is clear. If it is clear, give the best feedback, whatever you can give, because feedback will help you to see me once again. Feeling confident on buyback. Rohanjan, very good. Yes, sir, definitely. Please explain second equation. Second equation is very simple, beta. In second equation, what we are doing, let's understand the equation once again. In equation number 2, what we are doing, we are saying that face value of buyback is equal to, we are calculating the face value of buyback, which is equal to x, which is equal to amount permissible for buyback, that is y, divided by face value, issue price per share, issue price, buyback price, sorry, buyback price per share. I'm just doing it for you. Buyback price per share into face value per share. So this is the equation which you are framing. So x is equal to y divided by 30 into 10 that we are doing. So x is equal to, what is y? Y we have calculated in equation number 1. That is 37,60,000 minus x. We are replacing y with 37,60,000 divided by 30 into 10. That we have done, beta. Is that clear, beta? Charu, is that clear? Charu, waiting for your. If there is any doubt, tell me in this. Forward these lectures to maximum persons to whomsoever you know, so that they can also get benefit out of these lectures. Charu, waiting for your answer. Is that clear, or I would like to explain it in detail? If you will say, I will like to explain it in more detail. If you have any doubt in this. This is face value of buyback, which we are using in this concept. And this is assumed as equivalent to x, which is also, you may say, equivalent to the amount to be transferred to CRR. Okay, it's clear to Charu. So assuming it is clear to everyone, I have done, or you have done all the questions. You have to do all the illustrations, all the questions once again. You have to do the examination questions once again, so that you can do more and more practice. Try to get good marks in your final examinations. The best way to get good marks into your examination, I may give you those tricks also, those system also, but for that we need one more lecture or some extra time. So it doesn't matter. I would like to help you in some way, whatever it is possible. Otherwise, be clear that you have to go into your exam without any stress. This paper will give you more than 80 marks into your exam, and it will help you to clear group 1, group 2 very easily. You have to concentrate on these 3 chapters specifically. Concentrate on all chapters, because all chapters are very important. In these 3 chapters, that is advanced partnership accounts, we are normally getting 20 marks question. In buyback of shares also we are getting 8 to 10 marks question. In ESOPs also we are getting 10 marks question. So cumulative, if you see, these chapters will cover minimum 35 to 40 marks of your paper. So to get 40 marks out of these chapters, you should have to practice more and more. Also practice other chapters, because other chapters are very important also. So get very good marks and send me your results. I would like to see your results at some platform, so that we can understand that how much is the benefit going to you. Provisions are not part of debt, beta. Rakesh Vyas, your query is very good. Only liabilities are part of debt. Provisions are not part of the debt. It's provision for bad debts, provision for income tax, provision for any type of provision is given to us in the balance sheet. In the liability side, that will not be added while calculating the amount of debt. Okay, then thank you very much. We'll meet you once again at some platform. Thank you. Whenever I say give me the opportunity, I would like to meet you once again. Okay, then thank you very much. Sarji, we can close the lecture. हाँ जी सर, क्लोज.